Okay, so good evening. So we are still in partnership accounts, right? So in partnership, we have already discussed some of the key areas like preparation of profit and loss appropriation account, partners current account, and capital account. Uh, Two main adjustments in the capital account. One is goodwill, the other one is the revaluation of assets and liabilities, right? Then we did a question which is related to the retirement of a partner, retirement of a partner, right? So today what I'm going to do is I'm going to discuss some A-level past papers. Right? Let's start with 2017 paper. 2017 paper. Question number 2, part 2, question number 2. Okay. Amal, Kamal, and Nimal carried out a partnership under the following terms. All the partners are entitled to an annual interest of 10% based on opening capital balances. Profits and losses are shared among Amal, Kamal, and Nimal in the ratio of 3:2:1 respectively. Right? So there is interest on capital 10%. Profit sharing ratio is 3:2:1. Profit for the year ending 31st March of the partnership before appropriation to the partners as per the draft income statement was 3.4 million, 3,400,000. However, the following errors in the accounting records of the business were revealed subsequently. So before the appropriation, the net profit is calculated at 3,400,000, but this is before the error corrections. So there are some errors. So once you correct the errors, this profit will change. This profit will change. So there are 4 errors. The salaries of the employee 360 has been debited to salaries account as 630. Interest paid 100,000 on bank loan credited to interest income account. Office equipment 300,000 purchased has been recorded as office expenses. Depreciation also we need to adjust. Amal's life insurance premium. So this is his personal life insurance premium has been paid by the business and it has been treated as insurance expense. So this is not insurance expense, this is drawings. On 31st March 2017, Amal retired from the partnership. On this date, the goodwill of the partnership was estimated as 1,800,000. Goodwill account is not maintained in the books and all the adjustments are made through the capital accounts of the partners. It was agreed to maintain an amount payable to maintain the amount payable to Amal as loan in the partnership. Kamal and Nimal agreed to continue the business sharing profit and losses 2:1 respectively. So that is the new profit sharing ratio. Old ratio is 3:2:1. New ratio is 2:1. Capital account, current account balances, both credit balances, require journal entries to correct the errors with narration. So don't forget the narration because you will get marks for the narration. Statement showing the correct profit of the partnership for the year ending 31st March. So correcting the errors, then the adjusted profit, statement of adjusted profit, capital account and the current account of the partners. Okay, shall we start this? So initially we have to do the error correction of errors, and statement of adjusted profit. Correction of errors and statement of adjusted profit. So draw a general journal. Draw a general journal. Also, we need a statement of adjusted profit. Statement of adjusted. Plus minus adjusted profit. In the workings. General journal and the statement of adjusted profit. And also working side to separate. Working number one. Number one. Profit before adjustments is 3,400,000. We are doing thousands even. So let's start. Adjustment or the error 1. The salaries of employees 360 has been debited to salaries account as 630. So this is salaries expense. The salaries of employees, right? So this is either it could be cash or salary payable. So that amount is correct. But salaries account, they have debited this 630. Cash is correctly recorded 360. Cash is correctly recorded. But in salaries account, it has been recorded as 630. So how do you correct this? Cash is correct. This has to be deducted. 630 minus 360. So salary expense account should be credited 270 and the other entry goes to the suspense account. So double entry is suspense account debit 270, salary is expense account credit 270. Correction of salaries 360 debited to salaries 630. Salaries 360 recorded in salaries account as 630. So that's number one. Then working number two. Working number two. The interest paid 100,000 on bank loans has been credited to interest income account as 10,000. So the account is also wrong. The amount is also wrong in this transaction. So what has happened is this is interest paid. Actually, this should go to interest expense account. But without recording in the interest expense account, they have recorded this in interest income account. Interest income account credited to interest income account as 10,000. So they have credited to interest income account 10,000. But this is not interest income, this is interest expense. So how do you correct this? First, you need to remove this entry from the interest income account. Remove this 10,000 from the interest income account. And you have to debit the interest expense account by 100,000 because that's the correct entry. So interest income account debit, interest expense account debit, and the total will be credited to the suspense account. Right? So we will write the double entry. So there will be 3 entries: interest expense account debit 100,000, interest income account 10,000, suspense account credit total 110,000. Interest paid 100,000 credited to correction of interest paid 100,000 credited to interest income account as 10,000. So that's number 2. Number 3. Third error, working number 3. So the third error is office equipment worth 300,000 purchased on 1st of April 2016 has been recorded as office expenses. So 300,000, it's a purchase of equipment, but it was recorded as office expenses. Depreciation is provided at 10% per annum for office equipment on straight line basis. Right? So what they have done is recorded as office expenses 300,000. It was debited to office expense account 300,000. But this is not office expense, this is office equipment. We have to remove this from expense account, edit this amount in the equipment account. So once you record this, double entry is equipment account debit, expense account credit. Debit 300, is expense account credit 300. So this is correction on purchase of office equipment 300,000 recorded as office expenses. Not only this, you also have do the depreciation. You have to do the depreciation. So once we transfer this amount to the equipment account, we have to calculate the depreciation. Since the year end is 31st March 2017 and this was purchased on 1st of April 2016, there is 1 year depreciation at 10% per annum. Double entry will be office equipment depreciation expense account debit office equipment provision for depreciation account credit. It's 10% means 30,000. Office equipment so that is depreciation. So you have to first transfer this from the expense account to the equipment account, and you need to calculate the depreciation for the year. 1 year depreciation at 10% per annum. Then we have the last one, number 4. So what has happened in number 4 is Amal's annual life insurance premium 150 has been paid by the business. And it has been treated as insurance expense of the business. So working number 4, insurance expense. They have treated or debited insurance expense 150. But this is not insurance expense, this is drawings. So how do you correct this? Credit insurance expense and debit drawings 150, 150. Drawings account debit 150. Insurance expense credit 150. So the narration will be collection of drawings 150 recorded as insurance expense. Drawings recorded as insurance expense. Okay. Now, statement of adjusted profit. So what is statement of adjusted profit? It's correcting the profit. After the error correction, the profit will change, right? So what will change the profit? What will change the profit? The profit will be changed from income and expenses. So what we have to do is we need to identify what are the income expenses changed during correction. So, from the general journal, we need to identify the income expense accounts. So what are the income expense accounts? So I will highlight salaries, interest expense, interest income, office expense, depreciation expense, insurance expense. So these are the accounts which will affect the income or expense. So whatever I have highlighted now, these accounts will affect the income or expense, because these are the income and expenses, right? So whatever credit entries will increase the profit. So there are 3 credit entries. This will increase the profit, and the debit entries will decrease the profit, right? So 270, 300, 150. These 3 amounts will increase the profit. Hundred, 10, 30. So these 3 entries will decrease the profit. Always credit will increase. Yes, that's correct. Always the credit will increase, debit will decrease. So 270 is salaries. Salaries credit means salary decreased. Expense decrease means profit increase. Office expense, insurance expense. So all these 3 expenses decreased. Decrease means profit increases. Then debit means these are expense. Debit means profit decrease, interest expense. Interest income debit means income decrease, then profit will decrease. Office equipment depreciation. That. What is the adjusted net profit? Tell me how much is the adjusted net profit? How much is the adjusted net profit? Additions, we have 720. Deductions, we have 140. Therefore, adjusted net profit is 3,980. 3,980. So this is how you do the statement of adjusted profit, net profit. Now we have to do the capital and current accounts. So let's draw a capital account and a current account for this question. You can write the answer, and I will draw the capital current accounts. So let me take format. So draw the format for capital and current account. So there are three partners. Amal, Kamal, Nima. AKN. And so AKN. So first, let's record the opening balance. Capital account, opening balance 4,200. Kamal is 3,000. Nimal is 2,000. Current account, opening balance. All credit balances 800, 500, and 300. So that's opening balance. So we took the balances here. Credit balances, capital current accounts, Kamal, Kamal. Then you also need profit and loss appropriation account. Again, the question, without recording debit and credit like this, we can have one statement. Credit will be plus, debit will be minus. So that method also you can do it. That's not an issue. Okay, now we will prepare the appropriation account because we need to transfer, we need to distribute the profit to the partners. So there are two transactions which is related to distribution of profit. One is annual interest of 10% for the capital balances and profit sharing ratio 3:1. Since the partner is retiring, the Amar is retiring from the partnership on 31st March 2017. That's end of the year. Since he is retiring at the end of the year, right? First, we need to distribute the profit to the partners. Okay, so draw the appropriation account. Profit and loss appropriation account. Appropriation. Profit and loss appropriation. So we need to take the adjusted net profit. So adjusted net profit is 3,980,000. 3,980,000 is the adjusted net. And let's calculate the interest on capital, which is 10%. Interest on capital. Amal, 4,200 into 10%. Kamal, 3,000 into 10%. Nimal is getting 2,000 into 10%. So we calculate the interest on capital at 10% on the opening capital balances. Right? So 420, 300, and 200. So total 920. Current account credit. Interest on capital. 420, 300, 200. Interest on capital. Then what we have to do is the share of profits. There is no any other distribution, no salary, no interest on borrowings, right? No interest on current account. Therefore, the remaining profit we have to distribute among the partners based on their old profit sharing ratio. Amal is getting 3/6. 3:2:1, total 6. Kamal will be getting out of 3,060, he will get 2/6. And Nimal will get 3,060 into 1/6. So we have to calculate 3/6, 2/6, 1/6. Total 3060. So that is share of profits. 1530, 1020, 510. Now the retirement. So when there is a retirement, mainly there are two adjustments that they give in the exam. One is the goodwill and the second one is revaluation. So here there is no revaluation, there is only a goodwill adjustment. On this date, the goodwill of the partnership was estimated at 1.8 million. The goodwill account is not maintained in the books, and all the adjustments are made through the capital account of the partnership partners. So the double entry for the goodwill is very simple. Like last time also I gave the double entry for the goodwill, which is capital account credit old ratio and debit new ratio. Capital account credit A, K and N. Credit A, K. Always all ratios. Yes. Okay. Ratio. Okay. So total is 1800. 1800. All ratio is 6 to 1. So into 3/6. 1800 into 3 over then 1800 into 2/6. 1800 into 1/6. 900, 600, and 300. Amal is retiring. Amal is retiring. The other two partners sharing the profit losses 1:2. Sharing the profit and losses 2:1 respectively. 2:1 means total 3. So 1800 into 2/3. Then 1/3. So that's the goodwill. So we have done all the transactions. Now the retirement process. Debit 1200 and 600. Credit 900, 600. Goodwill tablet. Now the retirement process. What we have to do is first transfer the current account balance to the capital account. Right? So before that, we need to see whether is there any transaction which affected capital or current account in our general journal. So there was a drawings of 150. There's a drawings of 150 drawings. So this has to be recorded in the current account. Because it was not recorded in the current account, we have to record that. Drawings. So this is whose drawings? Amal's annual insurance. Amal. 150. So that's Amal's drawings. Amal's drawings will be deducted from the current account. Then let's do the retirement of Amal. So when he is retiring, initially we have to transfer the balance to the current account balance to the capital account. Transfer to capital. Here we can say transfer from current account. So what is the balance? Credit side is more. So you calculate the total credit, which is 2750, and difference is 2600. So we transfer current account balance to the capital account balance. In the capital account balance, we have to transfer to the loan account. How much is the capital account balance? Credit side total 7,700. So that's the amount we transfer to the loan account. Loan account 7,700. Other two partners, we can take the balance carried down, balance breakdown. Balance breakdown. Closing balance in the current account is 1,820 and 1,010. Capital account balance 2,400 and 1,700. Right. Any questions? So there is a question. So can you tell the steps to do the partnership? So steps means on this question, each question has different steps. But when there is a retirement, right? First step is you do the appropriation account, then current account balance transfer to the capital account, then the capital account balance transfer to the loan account, or if it is paid, the difference will be transferred to the cash account, cash payment. So we will do another question. Right. So let me do 2013 paper. Question number 8 in our queue. Question number 8 in our queue. This is 2013 A-level paper. So this is a good question where the requirements requirement is income statement for the year ending 31st March 2013, including appropriation to the partners. So we need to prepare an income statement. Partners' capital and current accounts for the year ended 31st March, and the loan account of Rajitha as at 31st March. So this is where there were three partners at the beginning: Mahendra, Narada, and Rajitha. Profit sharing ratio 5:3:2. So we have the statement of financial position 31st March 2012. Non-current assets, current assets, capital accounts, current accounts, non-current liabilities, current liabilities. Additional information. 1st of April, Rajitha retired from the partnership. So 1st of April 2012 means that is beginning of the year itself, Rajitha is retiring from the business. It was agreed to treat the amount payable to Rajitha as a loan and pay an interest of 5% per annum on it. On this day, the goodwill of the partnership was estimated 1.2 million, 1,200,000, and all the adjustments in this regard should be made through the partner's capital account. Mahendra and Narada agreed to continue the partnership under the following terms: annual salary 120 for every partner, profit loss shared equally. During the year, Mahendra and Narada have obtained 200,000 and 100,000 respectively as borrowings in cash. All the sales and purchase of the partnerships are made on credit basis. During the year, 1,800,000 was collected from the debtors, while 900,000 was paid to creditors. Operating expenses paid 350. Interest on loan are to be paid. PPE depreciated 20% per annum on the straight line method. Current assets and current liabilities of the partnership were as follows: inventory, debtors, cash, creditors. So we need the income statement, appropriation account, capital current account, loan account. So draw the income statement, current account, capital account, and ledger accounts for inventory, debtors, creditors. And cash. Income statement. Draw a format of income statement. Capital current accounts. This previous question. Right. Capital account and current account. Three partners: Mahendra, Narathan, Rajit. Appropriation account also we need to put that. So in appropriation account, we have only salaries and profit share. There are two partners, only two partners remaining in the business. Beginning itself, Rajita is retiring from the partnership. Then we need to draw the ledger accounts. Ledger accounts for uh, debtors, creditors, and cash also we will prepare. Cash is not a must, but we will prepare. Trade debtors, trade creditors. Right. Let me record the opening closing balances. Opening balances for capital current accounts. Capital account. Mahendra Narada 200 400. Current account 150 100 60. Um, 60. That's the opening balance. Then what happens is, beginning itself, Rajitha is retiring from the partnership. So first we have to do the retirement. On 1st of April 2012, Rajitha retired from the partnership. It was agreed to treat the amount payable to Rajitha as a loan and pay an interest of 5% per annum on it. On this day, the goodwill of the partnership was valued at 1.2 million, and all the adjustment in this regard should be made through the partner's capital account. So first let's do the goodwill. Goodwill, it's very simple. Credit old ratio, debit new ratio. Total goodwill is 1200. So 1200 divided by old ratio is 5 is to 3 is to 2, total 10. So divide by 10, multiply by 5. Divide by 10, multiply by 3. Divide by 10, multiply by 2. That's the credit. Old ratio credit. Then Rajitha is retiring. Rajitha is retiring. So when he retires, the remaining partners share profits and losses equally. Share profits and losses equally. So when Rajitha is retiring, 1200, we have to divide equally 600, 600. Now let's do the retirement. So retirement program, the process, first transfer to the capital, then you transfer to the loan. Right? There's only 60,000 for Rajitha. So that 60,000 will be transferred to the loan account. So capital account from current 60. So this will be transferred to the capital account. Now he doesn't have a balance in current account. Then the current account balance will be transferred to the loan account of Rajitha. how much will be transferred? Profit, which is 500. So loan account, transfer to the loan account 500. So they're asking the loan account as well. So let's prepare the loan account. Loan account. Credit from the capital 500. Loan account 500. Then we need to prepare the income statement and the appropriation account. So let's start with identifying the balances from trade debtors, trade creditors, identifying the purchases and sales. Let me complete the trade debtors account. Trade debtors opening balance is 450. Balance brought forward is 450. Closing balance is given trade debtors 500. So normally these type of questions in the trade debtors account, there will be 4 transactions: opening, closing balance, sales and cash. Opening balance 450, closing balance 500. So other than that, they have given all sales and purchases of the partners are made on credit basis. During the year, 180 was collected from debtors. So cash collected from debtors is 180. That means the difference is the sales. So how much is sales? Credit 680. Difference will be 680 minus 450, which is 230. That's the total sales. Because there is no cash sales, all the sales are on credit. All the sales are on credit. So you find out the credit sales from the trade debtors account. Then we will do the creditors account, opening balance, closing balance, cash, purchases. So similar to the debtors account, from the creditors account we find the purchase. $1,200 minus 200 is equals to 1,000. Purchases is 1,000. So you can take the income statement, purchases 1,000. Cash balance, opening balance is given here 60, and the closing balance $260. So let's record the inventory as well. Closing inventory 275, opening inventory 200. Opening 200, closing inventory 270. Cash received from debtors. Oh, sorry, I made a mistake. Cash received from debtors 1800. I have taken the 180. Yeah, so this is 1850. Sorry for that. Sales is 1850. It's 1800. And in the cash account, cash received from debtors is 1800. Payment to creditors is 900. So let's record the other transactions. Operating expense paid during the year 350. There is no payable balances. So cash account credit, operating expenses 350, cash account credit, and expenses account debit. Operating expenses 350. Operating expenses 350. Interest on loan are to be paid. So still it was not paid. Depreciation is 20%. Interest on depreciation. 1000 is the cost, 20% per annum. 20% per annum on straight line method. So it's 200,000 into 20% is 200. Depreciation is 20%. Now interest on loan. So there are two loans. Interest on loan for Narada, interest on loan for Rajita. Because Rajita's amount also we have transferred. 5%. Narada 200 is the loan amount, 5% interest. Rajita 500 loan, 5% is 25. $200 into 5%, 500 into 5%. So those are the transactions which comes under the income statements. Other than that, what do we have? We put all the balances from the statement of financial position, right? And there is partner salaries. Annual salary 120. So there are two partners, M and N. 120, 120. That's annual salary. 4240. Other than that, what do we have? We have drawings. During the year, Mahendra and Narada obtained 200 and 150 as drawings. Drawings will be debited to the current account. Debited to the current account. How much? 200 and 150. 200, 150. That's it. So find out the net profit and share the net profit among the partners based on the new profit sharing ratio. New ratio is it equal? Yes, equal. So let's find out the net profit. Net profit is 925. So gross profit is 925, net profit is 340. Now interest from Narada's loan that comes to the current account. Narada 10,000 will come to the current account, but Rajitha, it won't come to the current account, it will be recorded in the statement of financial position. Once we complete this, I will explain the statement of financial position. Interest on loan. Then the net profit will be transferred or distributed among the partners. 100 M and N. 50-50. 50-50 means 50-50. So that's the share of profits. 50-50. So that's all. There is a question why only Narada's loan interest is recorded in the current account, because Narada is a partner in the business. Rajitha is not a partner now. all his balances were transferred to the current account. So he is a outsider to the business. So find out the closing balance and the answers. No balance for R. Capital accounts also we can balance. Two hundred, 160. Two hundred, 160, 120, and 130. One is 350. Yeah. So if you prepare the SFP, statement of financial position, then you have to take these closing balances, the loan account for R, and his interest on loan will come. And other amounts you can take from the previous statement of financial position. That's how we do this question. Any doubts? Okay. So complete this. Someone asked the previous question. answer to take a screenshot. So here you can get a screenshot from this, the previous question, question number 4. Right? If you want to take a screenshot, you can take it. And this is question number 8. This also you can take a screenshot if you want. Income statement, appropriation account, capital account, current account, and the required ledger accounts. Okay. Any other questions before we conclude? Is it clear? Right. Okay, so we finish from this. So in the next class, I will try to start the new chapter. Okay. So good night and take care. And I'll see you on the next session with new chapter.